The International Monetary Fund estimating that a half percentage point will be shaved off of economic growth this year. That means 2.8%, down from a prior estimate of 3.3%. It's all according to the IMF's new World Economic Outlook. Joining us now with more is Yahoo Finance's Jennifer Schonberger. Hi, Jen.
Thank you, Julie. For more insight on today's World Economic Outlook, I want to welcome into the program IMF Chief Economist Pierre Olivier Gourinchas. Pierre, thank you so much for sitting down with me. It is always great to see you.
Thank you.
You warned today that tariffs and uncertainty around tariffs will lead to a significant slowdown in global growth in the near term. What is the risk of a global recession as well as a recession here in the United States?
Well, so we are seeing a significant slowdown in growth. We're projecting 2.8% in 2025, 3% in 2026. That's down 0.8 percentage point cumulated over these 2 years at the global level. This is not a global downturn. This is not a global recession. What we're seeing is an economy that is going to grow at a slower rate, but we're also seeing a risk of a recession increasing. And when we do our calculations, we run our models, what we find is that at the global level, that probability of a global downturn, if you want, has increased from a little bit more than 15% back in October to about 30% now. So that's a significant increase, but we're not there yet. We have run a number of scenarios looking at the different tariff announcements, April 2nd, April 9, with the pause, et cetera. All of them land us towards this 2.8% that I just mentioned for growth. So this risk of a global downturn is if things were to take a turn for the worse. And if we are looking at the U.S., since you asked me also about the U.S., so for the U.S., growth is also going to be slowing down quite a bit to 1.8% in 2025. Again, not a recession, but the odds of a recession have also increased. They've more or less increased from about 25% to close to 40%. So again, if something were to happen that would take a turn for the worse, then we could have a recession. But we're not there.
In terms of perhaps taking a turn for the better, we're hearing that Treasury Secretary Scott Bessent is saying that there will be a de-escalation between the U.S. and China in the very near future. He's saying the goal is not to decouple from China, though he does admit that it will be a slog when it comes to negotiations. He talked about the prospect of trying to get a comprehensive deal in the next 2 to 3 years. Of course, this also hinges on China's side as well. What are your thoughts on that? Is that helpful, or given the length of time, could we still see some sort of decoupling between the two economies? Is there damage that could still be done?
Well, it's certainly something that goes in the right direction, very much in line with what we are calling for. One of the things we're seeing right now is not just the fact that we have potentially very elevated tariffs, in particular between the U.S. and China, but there is also tremendous uncertainty. So if you're a business and you're thinking about where to expand, where to grow your markets, where to source your products or your inputs, it's very unclear at this point for many of them, and that uncertainty is something that is hurting economic activity in the U.S. and in the world. So anything that will go in the direction of providing more stability, more clarity, and predictability in terms of the trading environment will be very, very welcome. Now, the question is what will happen during that period of time when things are negotiated. If we get tariffs that remain elevated or if we still have uncertainty, that would still weigh down on growth. So we would certainly call for all the parties to sit around the table, figure out how they want to handle this, and bring back a certain amount of predictability in the trading environment.
Do you think we're in the midst of a reordering of the global trading system? And does the U.S. still sit at the forefront of that? Or is this a system that's going to look different?
We're probably going to see a system that looks quite different from what we used to have. I mean, I think what we're seeing right now is the culmination of a process that has not started in the last few months. This has been years in the making. The trade tensions have escalated. We've seen the proliferation of trade distorting measures between countries, whether it's subsidies or industrial policy, or in some cases tariffs. So there is a need to rethink some parts of the system, make it better, make it work for everyone.
Do you think that we could see tariffs and non-tariff barriers actually come down, and perhaps this boosts global growth? We see a leveling of the global trading field? Or on the flip side, do you think countries just continue to turn inward, moving away from globalization, a trend that we have been seeing in recent years, and becoming more protectionist?
Well, if we end up with a place where we have fewer non-tariff barriers, where fewer tariffs, And countries can recognize that trade is something that offers better opportunities for everyone, and implement the kind of policies which we actually described in our report that address some of the domestic imbalances, things that would help the U.S. economy maybe have smaller fiscal deficits, the Chinese economy rebalance its demand towards domestic demand as opposed to external demand, the Europeans do public infrastructure investment that would boost their productivity. All of these things would deliver a world where we have higher growth, we have fewer trade imbalances at the aggregate level, and then that's a better world. A world that turns inwards or remains inwards, as it's already taken a turn in that direction, is a world that has lower activity, lower standards of living in the short term, in the medium term, in the long term.
Pierre, typically in periods of stress and uncertainty, we see a flight to safety into the U.S. dollar and U.S. treasuries. We're not exactly seeing that play out this time. There were rumors that perhaps China was dumping U.S. treasuries. Treasury Secretary Bessent poured cold water on that. My question, though, is, are we on the precipice of a loss in confidence in the full faith and credit of the United States?
We've seen some adjustment in portfolio composition. I think we have to see and take a step back and look where we're starting from. In the last few years, U.S. markets have done tremendously well. The U.S. economy was performing better than its peers. In fact, in our report, we document that it went back above the pre-pandemic trends, well ahead of other advanced economies and other countries in general. So the U.S. economy was doing very, very well. That attracted a lot of capital into the U.S. That strengthened the dollar during that time. We're seeing a bit of a reassessment around that. Growth is slowing, uncertainty is up, there are these trade tensions. Portfolio managers are responding to this. Valuations are adjusting, bond prices are adjusting, the currency is adjusting. All of this seems fairly reasonable. It seems fairly orderly. We're not seeing dislocation in currency markets. We're not seeing dislocation in bond markets. So all of this seems to us to be, par for the course, if you want.
What's the prospect for further devaluation of the dollar?
Well, I think it will very much depend on the relative performance of the U.S. economy relative to its trading peers. It will depend on the uncertainty about policies in the U.S. versus what's happening in the rest of the world. The U.S. will remain, and the U.S. dollar in particular, remains one of the key currencies in the international monetary system.
And you expect it to remain so?
And we expect it to remain so.
I want to ask you about the U.S. Federal Reserve. What is your outlook for monetary policy here in the United States? The Fed has penciled in 2 rate cuts this year. They have said they need more clarity on the president's policies. They see higher inflation, lower growth here, as you do as well. And that has sort of erred on the side of holding rates steady. At the same time, President Trump is calling for lower interest rates. Does the IMF believe that we need preemptive rate cuts? What's your outlook?
Well, we're seeing the shock of this escalated trade measures in the U.S. as a negative supply side shock. What does that mean? It means lower levels of activity and higher prices. So it's the kind of news that you don't like if you're a central banker, because you're trying to achieve full employment and you're trying to keep price stable. And here you find a situation where both of these things are harder to achieve. So from the point of view of the Federal Reserve, trying to assess the extent to which there are inflation pressures that could reemerge in the U.S. economy and how persistent they might be is going to be absolutely critical. In our report, we're projecting that headline inflation in the U.S. will remain at 3% in 2025. It was 3% in 2024. We expect it will remain at 3%, when before, in our previous round of projections, we were back at central bank target, 2% for 2025. So we're a full percentage point above. Now, in that situation, it's very natural that the Federal Reserve would pause, see where things are going. If the shock to inflation is transitory and then inflation resumes its disinflation path, then they can resume their rate cut process. But we're just coming out of the worst inflation episode in decades. People are pretty scarred by the inflation they've experienced in the last few years. And it could be the case that the inflation expectations that businesses and households have start moving in ways that are not favorable from the Federal Reserve point of view. They have to be very, very, very vigilant on this, and that's why they have to remain firmly committed and be able to implement policies that will bring back inflation to target.
And before I let you go, Pierre, President Trump has grown frustrated with Fed Chair Jay Powell. He has talked about the threat of firing Powell before his term is up in May 2026. If the president were to move forward with that, what are the consequences of that decision as far as markets, as far as confidence, as far as the impact on the economy?
Well, one of the great things in the inflation surge and decline we've seen in the last few years, we actually have written extensively about this, is the fact that inflation expectations remained anchored, even though people were kind of shocked by the levels of inflation they saw because they had never seen that in a lifetime. They remained confident that the Federal Reserve would be able to achieve price stability. And that really helped the inflation process to come down very, very quickly. So that anchoring of inflation expectations is key. Now, where is that anchoring of inflation expectation coming from? From the credibility of the Federal Reserve, the fact that it can be trusted to do what is necessary to bring price stability. And where is that credibility coming from? Well, in great part, for many central banks all around the world, it's coming from central bank independence. So it's important to preserve that.